Good morning. How would you see this move now? And I was saying this earlier. Should we see what the Fed has now confirmed, what was already kind of being accepted as a fact by the mainstream, press and mainstream research, etc., that we'll see two hikes maybe later in the year? The Fed basically just said a yes to that. It confirmed that. Does that mean a clean run for risk assets like stocks around the world for a few months at least?
It's always half empty, half full, when you get into this discussion, because on the one side you can say that interest rates are going to rise irrespective by the end of the year. Or you can say that, well, they're not rising right now, so that's a good thing, and when they rise later on, we're going to worry about it.
By the way, it's not a given, Rohit, right? There are still... so Christopher Wood from CLSA, for example, I remember when this entire QE business started, rates will go up, and this is, I think, early 2015. He said, well, and that was a year back from where we are now, he said that we won't see rate hikes in the US for the next couple of years. Most likely we will see QE4, another round of quantitative easing. So it's not the mainstream view, but it's not a given that rates have to go up later this year. It could be next year, middle of next year, later later in 2017. Who knows? No one knows. We're just talking about it right now that maybe if conditions are appropriate, rates will go up. That's about it.
No. So let me put it in perspective. The way the markets have been moving is that they have been trying to discount what is being said rather than what is being done. So there's a lot of difference between what they say and what they do. To put it more specifically, a lot of the dollar rally last year was being related to, oh, well, they're going to raise rates. The dollar has rallied strongly all through the year in expectation of higher rates, and you've only had one rate hike so far, so the markets have already discounted much more than has actually happened. Okay, so let's understand that the market is discounting what the Fed is saying rather than what the Fed is doing. Okay, so
it's also got to do with the US economy, right? Underlying strength in the US economy.
That's again a debate, if you depending on...
I'm saying there are more than one debates on any given day, right?
Exactly. So depending on what you actually listen to, if you just look at...
And now, by the way, to complicate matters further, the Fed has said that we're worried about the global situation, not the US economy. So the rate hike is not dependent not on what the US economy looks like and does, but what the global growth does.
Which makes the situation even more dangerous, because what you are seeing right now is slowing earnings. Not just in India, of course, we are seeing it for all of last year. This is the second year consecutive that all earnings forecasts have gone for a toss. And the way it looks, I think, given this budget, next year's earnings forecast will also go for a toss. I could be wrong, but my sense is that's likely to be the case. And the same thing is happening in the US. You've actually seen negative earnings growth for the S&P a lot as a whole. So most of the GDP growth that we are reporting either in India or the US is not leading to higher and higher earnings growth simply because of the debt overhang. So are you going to discount the market based on the expectation of QE, or are you going to discount the market based on the expectation of higher rates? Or are you really going to discount it on the basis of earnings? So there are, that's why I said it's become a 50-50 discussion. What exactly are you discounting? Do you want to pay higher and higher valuations for weakening earnings? Or do you want to actually pay higher valuations in expectation that, well, more money is going to get printed and so asset prices are going to go up? So in that sense, then you're knowingly playing the bubble. You don't know how far it can go on. And in that sense, then it's a level-to-level market. And, just like you were discussing earlier, that it's a stock-specific market, because eventually money managers are allocating their capital just to where they can see the earnings growth, which is like 20% of the stocks in an entire market. And rest of the 80% of the market is actually suffering. And the index is at a high simply because we threw out all the stocks that were not growing and just kept in the ones that were growing. And 30 stocks in an index just reflect that. Even within the Nifty 50, only half of the stocks show positive earnings growth, half of them show negative earnings growth, and net the entire Nifty is degrowing in earnings. So you have this anomaly. And to me, this anomaly is basically means that you're in a bear market. You're going to play this market level to level. If you're looking at an index, it's going to move up 1,000 points. It's going to move down 1,000 points. And I call that a bear market. So this is a bear market, whether you call it or not. my definition of a bear market is essentially one where stocks don't participate, the market moves 1,000 points this way or that way from time to time. You can have a stock-specific approach if you're really good at bottom-up investing, which is barely 1% of the people in the market. But for an average investor to tell him be smart, it's not going to happen because most of them don't know what to do. And if they just generally buy something, they're on the losing end of the stick. So simply to tell investors at large that, you should keep investing, to me is not an apt strategy, simply because they'll not get what they are expecting that you do get from a bull market, because the approach has become very, very stock specific, and that means that you need to have a concentrated portfolio rather than a diversified portfolio.
There's a fantastic cover. It's the Economist's cover, latest one, dated 24th of March. It is talking about, it basically disaggregates earnings, profits for America. It says the title is Too Much of a Good Thing. Profits are too high. America needs a giant dose of competition. So it actually argues, going back 50 years, that it's never been this good for the private sector, corporates in the US, for a long, long time. And they're calling it the situation abnormal, Rohit. So, we can do a complete whole discussion on that later. But some very interesting numbers. And it does contradict some of what you're saying. For whatever reason, profits, according to this article and many others as well, buybacks, whatever you want to put it at, are extremely strong for the US market. S&P earnings are expected to be $120, putting the index at some 17 times earnings. It's moved from 15 in February lows to 17, but it's still, it's kind of sort of defied most calls over the years that this is going south. It's not. S&P is back about 2,000.
But earnings are degrowing. So that's the point I was trying to make. S&P earnings have degrown in the last quarter.
In the last quarter, very recently. And that also you can attribute to dollar strength, etc. So there are, there are things which you can, specific things which you can attribute the recent weakness in earnings to over the last 2 or 3 quarters. I agree with that. Another, but broadly what Rohit is saying, I don't think you can disagree with that, right? Which is the fact that overall you got to be very bottom up. If you just say this is a bull market, I mean the classic definition of bull market is you buy anything and you end up with a fairly high chance of making money. This is not that.
Absolutely, I agree with you. I mean, that's what I said earlier also. You have to take a stock-specific approach. It's not a bull market where, all stocks and sundry would move up. And it is to be expected because we are at an inflection point. And as Rohit mentioned, there are 2 schools of thoughts. One where which subscribe to the Fed school of thought, saying that there is a recovery in place. We would start to see interest rates to go up, and that necessarily is a good thing as long as there is a recovery in place, which would effectively mean that the largest economy in the world, which contributes nearly to 35% of the GDP, is started to move up, which effectively will start to take the other economies together. If you subscribe to another view where people are not sure about the earnings cycle, they believe that the debt levels are over event horizon, as people like to call it, which would mean that there is no way that the Fed can raise rates, and therefore the Fed has to keep doing another rounds of QE. And you have had market experts like from PIMCO who have talked about recession, and city analysts who have talked about recession. I don't know where the probability is coming from, where people have talked about 30% recession or 10% recession, because at the end of the day, you are seeing unemployment in the US starting to come down. Obviously, the problems in Europe are not over yet. The problems in the US are not over yet. So,
Clay, I don't know if you're familiar with him. He's an old-handed current, has lost 25-26% of its market value in about 10 days.
Correct.
Yesterday was a big fall, it recovered a little bit. How would you take something like Lupin? Top class management, great company, down now, what, 35 IT? Anything on the open in terms of Nifty specifically?
No, I didn't get your question.
The market, the Nifty, we talk about the Globe, S&P, profits, Yellen, the Nifty. Let's get back to
my sense is last week we topped very close to what was the 7760 mark, which is around 61% of the entire fall that we saw from October, which was the 8336 high all the way down to 6825. So 61% comes exactly at 77.60, and we haven't gotten past that. There are multiple other indicators also there. You have like the 40-week average, or some people would call the 200-day average, closer to that. You have a trend line which touches a lot of the highs coming there. So I think that's an important level. Not having surpassed that raises a red flag for me. The potential is very high that you've already topped out for the time being, and that you would head lower. One level that we would watch on the downside would be around 7405, breaking which would confirm that we are going back to test 6600. Something that most people have started to discount will probably not happen again, but I think we are going to be still very, very open to it.
Sorry, test what again?
The 6600 mark.
Right, okay.
So I would still be open to the potential that the markets could sell off once again. Like I said, we would confirm that below 7405, but the failure to get past 7760 is the first indication that weakness is coming back to the market. Then it's a question of, okay, whether it's going to dip 100 points, 200 points or more than that, and will it form a higher bottom or a lower bottom. But so far the pattern looks corrective, and my sense is then it indicates the potential to go much lower, so that needs to be kept open.
One keeps hearing that you need some fresh triggers. The old things won't just do it. You need something more to surprise, shock the market, scare the market. Is that true? Is that necessary, Rohit?
You mean scare the market on the way up?
On the way down? I mean, for what you're saying, for 6800 to play.
I think it was completely the opposite. When you headed into the budget, you were looking for something to snap the market up. And if you ask me, the
market did snap up, right, after that?
The market did snap up, but if you ask me, I would say for the wrong reasons. The reason I say that is that the government pulling back on its fiscal, while it may be good for interest rate trajectory, is not exactly good for earnings. It's not good for growth in general. So that itself could put downward pressure on average earnings for the market. So the broad-based recovery does not look visible all over again. So that's not exactly good news. The only thing you've rallied on is expectations that there'll be a rate cut. Do rate cuts work? I think there's enough discussion on that. RBI itself, the governor himself has made so many statements about not just focusing on rate cuts. So the action really has to move to something else. If you ask me what is the downward shock, you've got multiple things that can go wrong. Not just earnings growth, which will probably continue to get downgraded, but also the potential for shocks coming in from the banking system. I don't think the worst is over there. You'll keep getting news of restructurings, asset sales and so on, which will keep putting pressure on asset prices from time to time. So there's enough reasons why things can go wrong. The question is what can go right. I think that's the aspect that that's getting lost in the discussion.
Okay, all right. What can go wrong to take the market down, but what can go right to take the market higher?
Yeah, I mean, there are enough reasons to take it down. There aren't so many to take it up.
So you're saying we should focus on things which could take it up, actually?
Yeah, if you really want to find reasons to take it up, you need to search for them.
No, the point
They're
is
not easy
that
to find.
Given all the reasons why the market should go down, the market is anyway going up, right? So
I mean, it's just rallied for less than a month, and we are talking about it going up. It's been down for 12 months.
Yeah.
So
no, I'm just saying that it's back. It's back up 1,000 points in what, 15 days, 20 days?
But that's exactly what I said in January. You're going to get a market that's going to go up 1,000 points and 1,000 points up and 1,000 points down.
Yeah.
So to me, that's completely normal. That's what bear markets do. You get big rallies and then you get suddenly big sell-offs as well. The question is whether the rally will sustain, and there aren't enough reasons for that.
Ananda, what's the you travel quite a bit, you meet large H&I clients, that's what you do. What's the are they confident about that? Appreciate you coming in. Rohit, thank you as always for being here, and good speaking with both of you. See you back next week. Thank you. Let's just take a very quick